Over the last few years, the Indian stock market has felt like a massive party for retail traders. But, when a party gets a little too out of control, someone eventually has to show up and shut it down. In this case, that someone was the regulator, SEBI. So let's get into what actually happened and, more importantly, what it means for you and your trading strategy. So here's the big question that's been hanging in the air. Is futures and options trading really a golden ticket, or is it more of a trap? I mean, we've all seen those flashy screenshots on social media, right? Huge profits, overnight riches. But we've also heard the horror stories, accounts getting totally wiped out. So what's the real deal? Well, as it turns out, the truth was hidden deep in the data. Okay, so how did we even get here? Well, it was kind of like a perfect storm. You had zero brokerage apps making it super easy to start, you had nonstop hype on social media, and this powerful story that F&O was the fastest way to get rich. All of a sudden, everyone felt like a trader, and the market was absolutely on fire. And hey, who could blame them? The appeal was obvious. With just a little bit of capital, you could control these massive positions and, at least in theory, make life-changing money in just a few hours. It was pitched as the ultimate get-rich-quick opportunity, and pretty much everyone wanted a piece of the action. But here's the thing. While this massive crowd of retail traders was busy chasing that dream, a real nightmare was starting to take shape behind the scenes. This whole speculative craze was hitting a boiling point, and the market regulator, SEBI, was starting to get really, really nervous about it. Think about it. For every single trader posting that screenshot of a huge win, there were thousands, literally thousands of others who were just quietly taking devastating losses. SEBI knew something was deeply wrong, so they decided to dig into the actual numbers. And what they uncovered, well, it was a total bloodbath. 1.8 lakh crore rupees. That is an enormous number. That's how much retail traders lost collectively. Just let that sink in for a second. And this wasn't just, a few people having a bad run. This was a systemic problem. The F&O market, with all its promise, had basically turned into a giant wealth transfer machine, and all that money was flowing from the pockets of retail traders into the hands of a very small, select group. So, faced with a 1.8 lakh crore hole in the market, SEBI really had no choice but to step in and do something. Their goal was pretty clear: protect the small investor, often from themselves, and basically put an end to this casino-like atmosphere that had completely taken over. So, what did they actually do? Well, you could say they just threw a giant wet blanket on the whole party. They made it way more expensive to trade by jacking up margins and contract sizes. They cut down on the number of weekly expiries, and they generally just made it harder for smaller traders to get involved. It was kind of like a casino suddenly raising the minimum bet and shutting down half the table. And the effect? It was immediate. It was like someone just flipped a switch. Trading volumes just fell off a cliff. Retail traders, who had been the lifeblood of this speculative frenzy, saw their activity drop by 20%. And even the big players, the institutions, they cut back their trading by a massive 25%. The music just stopped. The party was officially over. But here's the real kicker. This pain was not shared equally. Not at all. These new rules hammered the small traders, the very people SEBI was supposedly trying to protect. Their participation dropped by a staggering 25%. Meanwhile, the bigger players, they barely felt a thing, with just a 7% dip. It was a classic case of the little guy getting priced out of the market. But the story doesn't stop there. SEBI's new rules didn't just change the trading game, they changed the entire playing field. And this is the part that I think most people miss, but it's arguably the most important piece of this whole puzzle. You see, it wasn't just about making traders adapt. The exchanges themselves were forced to go back to the drawing board. To comply with SEBI's new risk framework, they had to fundamentally change the very DNA of the market, the major indices that everything is built on. And the National Stock Exchange, the biggest player in India, was right at the center of all this. They literally had to redesign some of their most popular indices, like the Nifty Bank, to make them less risky and more diversified. It was a huge, huge undertaking, but it was absolutely necessary to fall in line with SEBI's new mandates. So what does that actually look like in practice? Let's take the Nifty Bank Index as an example. Before, it was kind of like a basketball team that was overly reliant on one superstar player. If that one player had an off night, the whole team was in trouble. But now, after the changes, it's more like a well-rounded team with a bunch of really solid players. It might be a little less exciting, sure, but it's also a heck of a lot less risky. And hey, in case you think I'm just connecting dots here, don't just take my word for it. Here is a direct quote from the NSE's press release. They're basically saying, yep, we're changing our index methodology because SEBI Circular told us we have to. It really doesn't get any clearer than that. So let's bring it all home. What's the bottom line for you, the retail trader, in all of this? It's simple. The game has changed. The old rules have been thrown out, and there's a whole new rulebook in play. The only question now is, are you ready to adapt? This right here is the critical what worked then won't work now moment. The old F&O market was a free-for-all, a total Wild West where anything went. This new market, it's much more like a gated community. Yeah, it's safer, it's more stable, but it is also a lot harder and more expensive to get into. And that brings us to what I think is the most important takeaway of this entire story. SEBI didn't show up to prevent the fire. They showed up with water buckets after the house had already burned down. And that's the fundamental truth about regulations. They are always a lagging indicator. They're designed to solve yesterday's problems, not protect you from tomorrow's. So I'm not going to leave you with a prediction. Instead, I'll leave you with a question to really think about. The market has fundamentally changed. The real question is, have you? Are you still trying to play by the old rules in a game that doesn't exist anymore? Or have you adapted to this new reality? The answer to that is probably going to determine whether you survive and maybe even thrive in this new era of Indian stock trading.